you can tell we have to prep for these a couple weeks ahead of time. We try and keep the information as updated as possible, but the stock market was actually down up to 8 weeks. And then last week, and it looks like this week, they're going to go back up. So last week was awesome, by the way. I don't know how closely you watch your statements, but if you were bummed out 2 weeks ago, you'll feel better now. The stock market just last week was up like 6.5 to 7%. Today, the market alone was up another 2%. So we have gone from down 20, which is the freak out zone for a lot of people. We have gone from kind of down 20% to for the year in the stock market to down about 12%. So that's a big jump in a couple of weeks. I didn't know exactly. I expected that to happen when we were down between 20 and 25, and it did, which was great. So I'm really glad that has happened. But I think if you can see this, and again, I know these get kind of small because we try and cram in a lot of information in there. But this says, here's the 3 months, 6 months, and 12 months after the day the market gets down 6 weeks in a row. So if the market goes down 6 weeks in a row, what happens in the next year historically? Does it keep going down like everyone thinks is going to happen? Does it rebound? Does it kind of stay the same? What happens? But you can tell over 3 months, not that much happens. There's some really good years. There's a couple of really bad ones, but the average is about 0.3, right? So you're higher 8 times out of 14 that this has happened. So you're higher 57% of the time. So to me, that's a coin flip. I don't know where we'll be in 3 months. I think this is going to be one of the ones that's a lot better because from the 6 weeks that we were down, we're up quite a bit now. So I would guess, just because where we're at, that will be one of the positive ones. But 6 months out, how does it look? It actually looks a little worse depending on how you look at it. Only 50% of the time is the market higher. And only 7 out of 14 times, which is again exactly 50%, it was higher. And the median was only higher by 1.7%. Again, not that good. So again, 3 to 6 months out from when the market is really bad, it's a coin flip on what it's going to look like. 12 months out, though, is a different story. A year after the market goes down 6 weeks, and again, I would think we're closer to this year part because we were down actually 8 weeks. So we went down more than the average. Look at what's happened. The median growth is 10.4%, and it's gone up almost 2/3 of the time. So I understand that, especially 2 weeks ago, a lot of people were having a lot of angst. But if you think about the average growth rate after the market's down 6 weeks in a row is 10%. Bonds almost mathematically should do well in the next year, barring interest rates going from where they are right now to just under 3, maybe potentially all the way up to like 3.5 or 4 in a short amount of time. But I think bonds will look a little bit better in the next year. And I would suppose that the stock market will probably be closer to this, which is a 10% growth rate. I'm going to add something to this that I think is super important. If you go back and look at all the webinars, or if you've been on them consistently, you'll know that I've said, I thought this year the market would go down 10%, right? Even to down 10 was my guess. I had actually hoped it went down 10 because I thought in January the market was overvalued about 20%. Well, there's 2 ways to break even on that. One is the market goes down 20%, which it did. The other is earnings go up. And earnings were really good in the first quarter. Earnings have been really good lately, just in general. I mean, Lululemon came out with great earnings today. CrowdStrike came out with great earnings today. There's Restoration Hardware came out, which is kind of like middle of the road earnings, because again, their furniture is, talk about supply chain problems are like the worst because it's a big thing. You got to move it and you got to put it in those huge cargo ships with those big expensive crates that you have to put them in. So they have a huge problem with inflation. But if you look at the valuation where we were then, I thought we were 20% overvalued. Well, right now the market's down, let's say at 12. But earnings were 13.1% up in the first quarter. Now, again, that's amortized over a year. So, but if we can get 10% growth in earnings and the market ends up down around 10, we now are at totally fair value, meaning the market is totally fairly valued. If interest rates get up to about 3.5, let's say by this time next year, maybe even by March, bonds are totally fair value. And actually, LPL thinks we're going to end the year up 10%. I don't share that view. I think we'll probably end the year, maybe down 10 or down 5, if I had to guess, which is still up from here. So that's positive. But then once that happens and you're fairly valued, there's no reason, and LPL research thinks it's about 5 years. There's no reason that for the next 5 years, you can't get back to 8 to 11% growth. in the stock market, and a little higher bond growth because you had such a terrible first quarter. And that bond growth will probably last 5 years as well. So I actually think that's great. I know that when you look at your statements, you might not feel that right now. But if you think about how much money we've all made in our house and in the bond market and in the stock market in the last 2 years, if we can unwind all of that with 1 year that's down 5 to 10%, that's a steal. I'll take that. If the reset is that for a year instead of a huge recession, that is a wonderful case scenario that I will take all day, all day. So even though it felt bad after the first quarter, and then maybe even as recently as 2 weeks ago, I think the next couple of years could look a lot better. And if this is the worst that it gets, 1 year down 5 or 10% after so many great years, that's not bad, right? That is not bad. And we've never really orchestrated that soft of a landing before. So I think that would be absolutely wonderful. So again, just look at some bear markets stuff here as we kind of end. This is the last slide. So I think this is interesting. 17 bear markets, which is down 20% or more since World War II. Economy's in a recession 9 times. The drop is 35% on average. We were about 20 so far in the last 15 months. Without a recession, there was 8 times, that the market went down this much without a recession. The Dow was down less than 24%, and that only lasted about 7 months. I would guess this is where we are, right? Down less than 24%, which we were, and then it doesn't last very long at all. And this isn't on there, but I'll tell you, does anyone know, well, it's tough to raise your hand in this environment, but the shortest recession in history was COVID, right? Because the government learned from 2008. We had a huge crisis. We stimulated the economy, came right back. Europe did austerity. They had a 10-year recession, right? Tripled it, 3 recessions in 10 years. So we did that again this year, right? This time, COVID happened, boom, we stimulated like crazy. So it was very short. Now that we stimulated probably a little bit too much, and we're causing inflation. But inflation recessions, meaning if there is inflation and we raise rates to knock it down, are usually the shortest ones. The shortest recession before COVID was 1981. We had come out of that, because it was kind of fake. The economy was, kind of bad in the late 70s, but the problem was inflation. Once you caused inflation to go down and once you fixed inflation, everything was fine. And I absolutely think that's what we could be in right now, where we raise interest rates 0.5% last time, 0.5% next time, 0.5% the time after that. Inflation goes from 8.3, which is where it is now, down to under 6, which is totally palatable and reasonable, hopefully even under 5 by the end of the year. If that can happen, the Federal Reserve won't raise rates anymore. Inflation will be slightly high, but it's not that big of a deal. And unemployment will be great. There's 11.3 million job openings. All of our accounts will still be way more than they were 3 years ago, if we're only down 5 or 10% for this year. And we could snap out of that recession, in maybe even 6 months by the end of this year. And we could be set up for another pretty good, at least half a decade. If that's what ends up happening, again, that's great. I don't like how we've kind of gotten there, because again, that's the exact same thing I've said the last 3 webinars. How we're kind of getting to there was very painful in the first quarter. But I hope that pain kind of abates throughout the year. And at the end of the year, you go, okay, that wasn't that bad. And then we can set ourselves up for a great next couple of years.